What's going to happen to our property markets in 2018? What do you think is going to happen? What do I think is going to happen? That's exactly what we're going to discuss in our show today as we unpack the 2017 Property Investment Sentiment Survey that I've just recently conducted.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the fourth time he's won a similar award in the last 6 years.
Welcome to this week's show, particularly to all the new listeners, and thanks for all the returning listeners for helping rank us as one of the best business podcasts in Australia. And this week we're going to delve into what's ahead for 2018. I'm going to give you some of my predictions at the end of the show, but beforehand we're going to discuss the results of this year's Property Investment Sentiment Survey. I've been running this survey since 2011, and this year I've partnered with Your Investment Property magazine, and together we asked our readers what they think's ahead, what they're planning to do, and this is pretty important so you can understand how you fit in, and it's also very useful because consumer sentiment, property investor sentiment does play a big role in how our property markets are going to perform. Now, just before we get on to that, I want to explain that as the end of the year is coming up and the holiday season is coming, you're still going to get a regular show from me each week. And I guess that's the wonder of technology, because even though Pam and I are going on an extended break, we're going on a cruise around South America and going to Antarctica, I'm going to give you some special summer series programs to enjoy over the break. I hope you're going to have a break. I know we are. And I'm looking forward to 2018. And I'm actually very excited by the results of the Consumer Sentiment Survey we conducted, because it sounds like you, my listeners, the readers of my Property Update blog, are also looking forward to 2018. So I've invited Ahmed Imam, Senior Property Strategist at Metropole in Sydney, to join me. So let's have a chat about this year's survey. Welcome, Ahmed.
Thanks, Michael. Now, Michael, I've just had a look at the survey results, and there are a few surprises there for me. But before we get into that, can I just get the ball rolling by asking you, why did you conduct this survey?
Well, I first started running this survey in 2011, and I've been doing it every year since, and it's now Australia's longest running, and actually it's the largest survey of property investor sentiment. I guess I first wanted to understand how property investors felt so I could write the right blogs, create the right content for them, and understand what's ahead, because consumer sentiment, in fact, property investor sentiment, is very important. It's as a leading indicator. It shows what people are planning to do for the next year. And that's, I guess, something that we've now been following trends for 8 years.
Yep. And the results certainly have been pretty insightful. Were there any surprises in the results for you?
Well, one of the surprises was that despite us moving into the next phase of the cycle, the market's slowing down a bit, still 1 in 2 of these investors, remember, we surveyed the readers of Your Investment Property magazine and My Property Update, so we're talking to a reasonably sophisticated bunch of property investors rather than the average Australian. And these people still saw opportunities in the property cycle. They were still planning, half of them were still planning to buy a property in the next 12 months, despite recognising that the markets were going to slow down.
Yeah, I think it's pretty clear that property buyers are intending to remain as active as ever, despite the fact that the boom is now, well and truly over in Sydney, and strong growth isn't widely anticipated in 2018. But what's interesting, Michael, is that the survey reveals that 50% of respondents plan to buy another property in the next 12 months, and 60% believe now is a good time to buy property. And this is despite the fact the majority of respondents, 64% in fact, believe that property prices will remain flat or increase by less than 5% over the next year.
Yeah, it's also interesting to note where many of them are planning to buy, particularly Melbourne, which they believe is going to give the best capital growth for the next 5 years. And not far behind was Brisbane. So as we unpack the results, some more interesting things will emerge.
Okay, great. Well, let's quickly go through the questions. We'll see the responses. And Michael, I'd love to hear your thoughts as we work through the results.
My pleasure.
Okay, great. So question number 1 was, how many investment properties do you currently have in your portfolio? And the respondents were given the option of selecting everything from 0 properties to 10 plus properties.
Sure. Well, it's interesting that this showed that there was quite a mix of people. Some owned 0 properties, but 20% owned 2 properties, 19% owned 1. In fact, the majority of them owned properties. So we're talking to a group of investors, as I said a moment ago, as opposed to the average Australian. And having said that, 7% owned 10 or more properties. So there were some reasonably sophisticated investors in this group. So what we're looking at is would-be investors and currently already investors.
Yeah, I think it's also important to note that just because someone may have more properties than you does not mean they are more successful. I mean, it's really all about the size and value of your asset base and the quality of assets within your asset base.
Now, that's a really good point. So what we don't know is where those properties are located, the total value of the properties. Because sure, you're right, maybe you could own one good property on the beachfront in Coogee and that'll be worth more than 10 regional properties and probably perform much better than them as well.
Yeah, that's right. Okay, so question number 2. What is your preferred investment strategy?
Well, close to 80% of respondents had a long-term view of property. They saw it as a high-growth asset rather than expecting cash flow. And that makes sense, doesn't it?
Yeah, it does. And I'm really pleased the majority have the right expectations as well. I mean, property is not a get-rich-quick scheme. It requires a long-term view. And, like we say to most of our clients, it requires a minimum of 10 to 15 years to achieve that level of financial independence.
What concerned me was 3% didn't have a strategy. So if you don't know where you're heading, how do you know if you've got the property that's going to get you there? And I guess that's one of the reasons people fail. And another issue was that about 11% were hoping to invest for positive cash flow. Now, interestingly, as we dig further, quite a lot more people did have positive cash flow. So even those investing for capital growth, by doing it right, by having the right finance structures, were able to achieve both capital growth and positive cash flow.
Yep. Question number 3. Is your property investment portfolio negatively geared or does it generate positive cash flow?
Well, I guess that's what we were saying just a second ago. So 38% of investors had negatively geared portfolios. In other words, despite owning some of them 2, some of them many more properties than that, they were already at the stage where the cash flow wasn't covering their outgoings, but that was only 38%. 27% were neutrally geared, which means that they'd held their properties long enough that the cash flow started to work. Because as you've often said, negative gearing isn't a property strategy. I think this also shows that the government, there was a bit of fuss a while ago, Ahmed, about should they remove negative gearing, and even the Liberals tinkered with the idea. But there is some concern that next time round we have an election, the Labor government could come in and one of their platforms, and they're probably going to reintroduce it, is the concept of removing negative gearing. But what our survey is showing is that it's only a short-term thing because over time you get positive gearing and people are doing this. People are getting into this, we're finding, to secure their financial future, and the government shouldn't interfere with that.
Yeah, exactly right. I mean, it is. And it should just be a short-term cost to get you into a good investment property. Whether your property is negatively or positively geared is really just dependent on how much you're leveraged at a particular point in time.
Sure.
Okay,
so it's not an investment strategy, and it really is a cost of doing business in the early days.
Exactly right. Yeah. Okay, so question number 4. Do you believe now is a good time to invest in residential property?
Well, this is interesting considering that we're talking to a more sophisticated audience who have been involved in property for a while because they own properties. 61% of them still said yes. Now, I've been conducting this survey through ups and downs since 2011, and it's interesting that that percentage remains much the same. What it shows, I guess, is that they aren't as fussed about timing or where we are in the cycle. Clearly, they're taking a long-term view.
Yep. And I think the next question follows on from that previous one. Question 5, are you planning to buy an investment property in the next 12 months?
Well, despite them recognising, as we speak a bit later on, answering another question, that there's not going to be much capital growth in the next year or two, more than half the respondents planned to buy an investment property next year, showing strong consumer confidence. Interestingly, it's actually much the same as 12 months ago when we asked the same question at the end of 2016. This time round, it's 51%. Last time round, it was 52%.
Yep. And I think it also shows that half the respondents are not being swayed by all that negative media that's surrounding the property market at the moment. And they're taking that long-term view as they should.
Makes sense.
Yep. Okay, so question 6 is, what type of property would you buy?
Well, it's interesting that the majority of investors wanted landed properties, whether it's a house, a villa unit, townhouse. That's what the majority wanted. 10% were still prepared to buy an apartment. Now, in my mind, it's not necessarily what you buy with regard to an apartment or house. It really is the location, because I'd rather own an apartment in the right location than a house, something with land in the wrong location.
Yeah, I couldn't agree more, Michael. And this doesn't surprise me in the sense that the biggest myth in property investment is they should always buy land because that is what appreciates. But as we've discussed on many occasions, not all land is created equal. So question number 7 asks, which of the following would you buy? And it gives the option of a new property, an off-the-plan property, an established property, or a property with value-add potential.
Well, 42% of the respondents wanted to buy a property with value-add potential, and I guess that makes sense at a time when they're recognising that the market's not going to deliver a lot of capital growth. They're prepared to manufacture capital growth. But it's a little bit scary that 4% are still interested in buying an off-the-plan property at this late stage in the cycle where they're probably going to be disappointed.
Yeah. Now, look, I'm not a fan of off-the-plan properties. I'm just not a fan of paying a premium for any property for that matter. Question number 8. Where would you buy for the best capital growth over the next 5 years? And respondents were given the option of selecting any capital city as well as regional Australia, and they're allowed to answer with multiple answers.
Well, Melbourne was seen as the most likely location for maximum capital growth over the next 5 years. 52% of respondents suggested that, followed closely by Brisbane. Now, interestingly, it's much the same percentages as 12 months ago. And those people who didn't choose Sydney 12 months ago, despite Sydney being a bit flat over the last 6 months, it still provided pretty good capital growth, better than Brisbane over 2017. 14% thought regional Australia was a good place to invest. And there's no doubt that there are some short-term opportunities in regional Australia. But boy, it's such a fragmented market that you'd have to be very, very careful where you invest there. And I wonder in 10 years' time when you look back whether you'd be disappointed not having invested in the big smoke.
Yeah. And look, this result doesn't surprise me. I mean, I'm on the ground in Sydney. I can see where the market sentiment is at for the Sydney market. Is it necessarily reflective of where it's actually at? No, but it's depending on a number of factors. But I think this is what the survey certainly reflects. Question 9. What type of property do you think will make the best investment over the next 5 years?
Well, the respondents thought a detached house in an inner and middle ring suburb of a capital city would be the most likely to be a good investment. 37% said that, while 23% would be looking for a property with potential to add value. So they're really talking about houses rather than apartments. And that's really the way the market's worked over the last couple of years, that well-located houses had better capital growth than apartments. On the other hand, if you haven't got a big budget, I'd rather have an apartment in the right location than a house in the wrong location.
Yep, absolutely. Question 10. What is your property investment endgame? And the options here were live off rental income, hold and never sell down all or some, or live off the equity strategy.
Well, a couple of people told me that I should have probably worded that question better, because some of those are not mutually exclusive. In other words, you may have to sell some down, but still live off the rental income or live off the equity. I guess the fact that 7% were unsure is not a good sign, because if you don't know what the end game is, then how do you know what to buy? But we've already discussed that before. 34% wanted to live off the rental income. And I guess that's what we're talking about, to live off your cash machine. But a portion of them saw the concept of living off the equity, 19% still a viable option. And it is if you've got a big enough asset base to be able to prove serviceability to the banks. So it's all about building an asset base first, then lowering your loan to value ratios and seeing how the market climate's going to be in the future, whether you can still use the borrowing off equity strategy or whether you've got to live off your rental income.
Yeah, that's right. And at least at the end, you'll certainly have those choices. We've had a lot of talks about housing affordability, so the next question is rather interesting. Question 11, are you planning to buy a new home in 2018?
Well, the percentage of people wanting to buy a new home, or I guess planning to buy a new home next year, was 23%. Interestingly, that's considerably higher than 14% 12 months ago. So why is it almost double the number of people? Maybe they're seeing the market slowing down a little bit. Maybe they're seeing an opportunity of getting in. We're clearly seeing more young people taking advantage of the first home owners grant, the first home buyers grant in the states that are offering it. That's adding a boost to the lower end of the market. So that was an interesting surprise.
Yep. And there's been plenty of talk about lending policies and some of those changes. And the next question seeks to answer that one. So question 12, have the recent changes in lending policies to investors impacted your ability to purchase another property?
The answer for more than half of the respondents was yes. The tightening lending criteria have impacted on the ability to purchase another property. And we know that the Reserve Bank and APRA have made the banks tighten their lending criteria, tightening their serviceability criteria. So especially those investors who've already got a substantial portfolio are going to just find it that little bit harder.
Yeah. And I think many of our clients have also experienced this, Michael. Question 13. What will be your biggest stumbling block to purchasing your next property?
Well, that follows on from the last question, really, doesn't it? Because 35% of people said difficulty with serviceability. 18% said having a difficulty getting a deposit. And I guess it depends where you are in the property ladder. Getting a deposit is very difficult first time round, because the affordability, the loan serviceability for first home buyers and for investors is probably as good as it's ever been with the very low interest rates. But the fact that you've got to find 20% of the value of a property in Sydney is very difficult. So there's a number of stumbling blocks, but interestingly, they all fall back to the same thing, Ahmed, it's finance.
Yeah, that's right. And investment is a game of finance. So I think in these times we have to really acknowledge the current financial climate. We have to adapt. We have to play the game. And if you're now unable to borrow or purchase a property due to some of the changes, it's really not the end of the world. I mean, you can take the opportunity to top up your buffers. You can ensure that you're always prepared for any unforeseen circumstances, and then you can simply wait and grow your capacity. So it's taking that long-term view again and making sure it makes sense to proceed.
Great. As we moved on, the next question really was about fixing interest rates. And it was interesting that half the respondents felt it was time to lock in interest rates, recognising that probably the next move from the Reserve Bank is upwards. But in my mind, and I have locked in interest rates in the last couple of months as a form of, I guess, protection and a certainty for my cash flow. But I don't really expect interest rates to move up too much or at all really in 2018. Our inflationary environment is benign, and even though we're creating jobs, our economy is still underperforming. And so the Reserve Bank would be very brave to raise interest rates, and it would only do so once the economy performs well or our housing market starts to outperform, and that's unlikely to happen in the next little while. So 46% thought it's a good time to lock in interest rates, and I did. But, Ahmed, I'm actually not a very good indicator of that, because every time I do, I find later on that maybe I shouldn't have done it so soon. Maybe it was that same this time round too.
Yeah. Okay, so the next question is a pretty good reflection on market sentiment and what people feel is going to happen. Question 15 was, what do you think will happen to overall property prices in 2018?
Well, interestingly, investors are less confident in the short term than they were this time last year. And that's not surprising, because the market has moved to the next stage of the cycle. So 64% of the respondents believed that property prices would remain flat or increase by less than 5% over the next year. But interestingly, very, very few of them thought the property values are going to crash, drop significantly. And I guess that's again because we're talking to a group of investors who are reasonably well informed.
Yeah. And look, this is highly dependent on location. I mean, like you mentioned, Sydney and Melbourne, for example, are very fragmented markets. They've got many sub-markets within them, and they all perform differently and at different levels. So there are always going to be some pockets that outperform others. Okay, so question 16. Whose advice do you seek or plan to seek for property investment advice?
While 26% of respondents plan to seek advice from a property strategist or advisor, I was surprised that 25% of them are going to seek no advice at all, and a small group are going to seek advice from their family. Now, maybe they know it all, or maybe they think they know it all, but I'd be very, very cautious. Despite all the significant research material you can get on the internet, the information you can get for free, there's just one thing you can't get over the internet and you can't get for free, and that's the perspective that comes only after years of having on-the-ground experience. So I applaud the quarter of people who are going to seek property investment advice. I'm a little bit concerned about the other quarter who weren't going to seek anybody's advice.
Yeah, I find that pretty scary myself. Not to mention that you can make some seriously costly mistakes if you buy the wrong property, or if you buy the property at the wrong price. It's not only going to cost you dollars, it'll cost you time. And you can't underestimate the long-term value that a property strategist or advisor can add to your journey. So just something to explore, I think.
I think so. So it's actually not a cost. It's an investment. And it's interesting that most successful investors do surround themselves with advisors in various areas and are prepared to pay for it. And the less successful people tend to get free advice over the internet.
Yeah. Okay, so question 17. Now, the next question, the respondents selected their gender. Now, it's a pretty simple one, but we had some interesting results, didn't we, Michael?
Well, I was surprised that 73% of respondents were males, when I know the readers of Property Update and Your Investment Property magazine are basically 50-50, males and females. So I'm not sure what to read into that, Ahmed. What would you read into that?
I'd say we're not entirely useless after all. What do you think?
Well, that could be one, or the other is we just do what we're told and our wives told us to fill in the survey.
That's always a smart option, isn't it? Okay, so the final question was, what is your combined annual household income?
And it varied considerably. So while a small group of people weren't prepared to share, so this was not a compulsory question at all, a large percentage of investors earned between combined family income between $100,000 and $200,000, but there was a small group that earned $250,000. So there were some ordinary mums and dads and some more wealthy property investors. It was a good spread to give us an indication of what the market thinks is ahead for 2018. And it was interesting to see that on average, people are comfortable. People are just going to keep doing what they're going to keep doing and not be swayed by some of the negative market sentiment, because their focus is on long-term growth rather than immediate equity boost. And that's good. I'm happy with that. After the break, Ahmed, what we're going to do is come back and I'm actually going to give my own personal views of what's going to happen in property in 2018. So thanks for working through this with me.
Thanks, Michael. Always a pleasure.
If you're looking to get started in property or to grow your existing portfolio, turn to someone you can trust for independent advice. The team at Metropole Property Strategists have been involved in over $2 billion worth of property transactions, creating wealth for their clients, and they can do the same for you. They don't sell property, so their advice is independent and unbiased. Metropole can devise a strategy, their buyer's agents will buy your property for you, or you could use their renovations team, property development or portfolio management services. Arrange a time for an obligation-free chat at metropole.com.au.
Well, before the quick break, we had a chat about what Australian property investors think is going to happen in 2018. And I said to you I was going to give you some of my thoughts. Now, what's going to happen to the property markets is really going to depend upon what the Reserve Bank does to interest rates and what APRA is going to do to tighter lending criteria. Having said that, I don't think the Reserve Bank is going to change interest rates over 2018. And APRA probably is going to leave us alone this year because it seems to have done its job pretty well. If that's the case, I think property markets are going to still be better at the end of the year than they started at the beginning of the year. But of course, there's not one property market. Each market's going to behave differently. I see the Sydney property market having run out of steam, but it's not going to crash like lots of others are suggesting. Instead, it's likely to grow overall between maybe 4 to 5, 6% per annum. Having said that, some areas are not going to have any growth at all. Others are going to do better. That's going to be the investment grade properties. That's going to be the A-class properties. So overall, houses are going to do better than apartments in Sydney as well. Similarly, in Melbourne, houses, townhouses and villa units are likely to be the best performing market, and they should still be growing above 6% and in some locations even up to 10% over 2018. Apartments are not going to do that well, but the older style flats, the more established properties in Melbourne's inner and middle ring suburbs should still grow nicely. I think the Brisbane property market's going to move up a notch, spurred by jobs growth and infrastructure growth, and Brisbane will probably perform overall around 3, 4, even up to 6%. So I see a little bit more growth in Brisbane in the coming year than there was last year. I think Hobart's going to perform really well again in 2018. It could even grow up to 10% per annum. Having said that, it's going to be encouraged by speculators chasing the next hotspot because all the people are predicting that's where the growth is going to be next year. But remember, hotspots become not spots very quickly. So because it's such a small market, it won't take a lot to swing it around. On the other hand, when the heat goes out, it won't take much to make it drop like other of those hotspots. So I don't think there's enough long-term growth drivers in such a small market. I'd be avoiding that a lot. I believe Canberra is going to continue to perform steadily, and it should grow between 4 and 7% as well. But excessive land tax is one of the strong disincentives for me for investors to buy in Canberra. Adelaide's likely to underperform again. It's not going to do too well. There aren't many growth drivers. It'll just chug along at somewhere between 0 and 4% growth. The Perth property market's probably near its bottom, but I can't see it having strong capital growth for a number of years yet. Just because it's bottomed out doesn't mean it's going to suddenly turn up again. What's going to happen is more stock's going to come on the market. As vendors start to feel a bit more comfortable, buyers are going to be a bit nervous. They're not going to suddenly push prices up. Too early for a counter-cyclical investment in Perth. And Darwin's got very few long-term growth drivers, so I think prices may stop falling, but they're not going to go up much. Look, there's lots of regional markets in Australia as well. I can't cover them all. In my mind, if you're looking as a property investor, I'm not talking about your home, you've really got to be where future growth is going to be. And future growth is going to occur where jobs are going to be created, where the economy is going to do well, where infrastructure spending is occurring, where population growth is occurring. And that's really currently in the big 3 capital cities of Australia, Melbourne, Sydney, Brisbane. And I'd be careful the sort of properties you buy there. There's a flight to quality at these times where A-class properties, good homes, good investment-grade properties are still going to be in strong demand, and secondary properties, B/C class properties, are not. So I'd be avoiding all the new and off-the-plan apartments, the wrong time of the cycle to look at that, new house and land packages. No time for speculation. It's the wrong time for speculation. This is the time to stick to known, proven, trusted strategies. And I'll be coming back each week in your ears, telling you about what's happening in the property market in 2018. Well, thanks for listening to the show, and thanks for being part of it in 2017, and I hope to be in your ears each week in 2018. For those of you who celebrate Christmas, have a fantastic Christmas. For the rest of you, have a great festive season. And I look forward to bringing you my summer series of podcasts over the months of January and the beginning of February. When I come back, I've got some great shows lined up. I've got some great guests and some fantastic topics. And I look forward to hearing your comments and answering your questions.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes, where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You learn some new ideas about property investment, success, and money in around 20 minutes.